Hello and welcome to Straight Talk. I'm Stephanie Domerat. In focus this week, Oregon's economy in 2026. If it feels unpredictable right now, you're not wrong. From inflation to interest rates and tariffs, a lot of people are wondering what happens next. So where are we headed and what does it mean for your wallet? Joining us to help us answer those questions, the state of Oregon's chief economist, Carl Riccadonna. Carl has more than 2 decades of experience forecasting the global economy, working for Deutsche Bank, Bloomberg, and BNP Paribas. Now, his teams have consistently ranked among the top economic forecasters in the country. Carl, thanks so much for taking the time and joining us today.
My pleasure, Stephanie.
It's a big thing to unwrap, so we appreciate you offering your expertise. I want to begin with when you briefed lawmakers in late 2025. You said the Oregon's economy showed important resilience last year. What did you mean by that?
Well, 2025 was a challenging year, to be sure, for the national economy and also for the state economy. But the point of resilience was really with respect to recession risk in the economy. And I know a lot of forecasters last year were very concerned about recession, and some of them went so far as to forecast a recession, which ultimately did not transpire. So the economy has muddled through. And we can see this in lots of measures. Here in Oregon, it looks like the labor market has hit a turning point where we've seen some months now of positive job creation, not distributed across all sectors, but especially in the service sector. And also, from my perch down in Salem, I can see the trends in tax revenue. And tax payments are a good real-time indicator of economic health. If we're in a healthy economy, tax payments are generally rising. If we're falling into a recession, then we would see both corporate taxes and also personal income taxes tend to fall into negative territory or decline. That has not been the case. So that's been an important real-time barometer for us over the course of 2025 to watch these tax payments and see that it is not behaving in a pattern that is consistent with economy and recession. Instead, we are muddling through, and I suspect in 2026 we may see some reacceleration.
Okay, well, yeah, we'll talk more about what we're expecting ahead, and definitely good news from last year. Lots of fears last year and talk of recession, as you mentioned, and a big story also last year was tariffs. Their worry that they would hit Oregon businesses hard and consumers. So looking back, how did that actually play out here in Oregon?
Well, the tariff rates were changed multiple times over the course of the year. And so if we remember back to Liberation Day, as it was called, on April 2nd of 2025, they were very high tariff rates that threatened to push the economy to stall speed, where we kind of lose enough forward momentum that we could fall into a recession. Ultimately, the tariffs were delayed and diminished relative to what was initially proposed. And what ultimately went into effect certainly is raising a lot of revenue for the federal government through taxes on imports coming into the country.
Which is what tariffs are.
Which is what tariffs are.
Yep.
And so that has raised a lot of revenue. It has slowed the economy to some degree, but not nearly the extent to which most forecasters were anticipating. That does not mean that it hasn't hit the manufacturing sector hard, both here in Oregon and also nationally. The manufacturing sector has definitely struggled in the last 12 months or so. That being said, we're in kind of a bifurcation moment here where we can see the service economy, private service sector in particular, doing well and maybe reaccelerating. The manufacturing sector, I won't say it's further deteriorating, but it has been a tough run as manufacturers are adjusting to tariff policy, reorienting supply chains, et cetera, et cetera. It's been a tough year. Maybe as we see some improvement in the service sector, that might pull the manufacturing sector along with it, but that's still an open question for 2026.
So speaking of manufacturing, Trump's goal when he implemented these tariffs was to have more manufacturing in the U.S. and to bring goods made here in the U.S., increase the amount of goods made in the U.S. If that, plays out and works in the way that he hopes it would, what would that look like? How long would that take?
Well, the funny thing about tariffs, you get all of the pain up front, and then any economic benefit you see comes a little bit later on in the process, right? So you put tariffs in place and immediately you see some price pressures in the supply chain. Sometimes it gets passed on to consumers, sometimes it doesn't get passed on to consumers. And that was a big mistake that a lot of forecasters had in 2025, thinking it all just gets passed along to consumers. And in a lot of instances, foreign producers will actually reduce their prices so that the price you're paying for a pair of sneakers on a shelf at your local retailer doesn't change in the face of tariffs.
And that's what we saw?
And well, we saw some pass through to consumers, but not full pass through to consumers. And there were important lessons from 2018 in the first Trump trade war, if you'll call it that. And we did not see that big inflationary impulse in that episode. And so that was a kind of a key learning for this time around. Now, the tariffs are much bigger in 2025. And so, it was unavoidable that some of that got passed on to consumers, but it was not the inflationary shock that a lot of forecasters were anticipating. So as we kind of look back to your original question about what this looks like, so we've kind of gotten through the worst of the price impulse, and now we're kind of paying very careful attention for those signals of the silver lining of tariffs, which is the onshoring of production. And we can see in, for instance, the Chinese export data that Chinese imports into the U.S. Did decline. So tariffs did do some of what they were intended to do. But it takes time for that reorientation of supply chains. So if you're a manufacturer and you need to build a new factory, you didn't do that on April 3rd of 2025, right? It takes a long time to procure land and make the investment and construction and all of those things. And so we're now in the phase where we're watching for that kind of second order benefit from tariffs. And in some industries where there was a lot of spare capacity, motor vehicle production, for example, we did already see, to add a third shift at a vehicle factory, you don't have to, build a new factory, right? You can just, get the personnel in place and ramp up production. Now, unfortunately for Oregon, we don't have a lot of vehicle production here, at least passenger vehicle production. But you're starting to see some signs of that other side of the tariff coin play out in the economy. I think that's a key focal point for 2026 and the rest of Trump's term.
As far as automotive
and other manufacturing.
Interesting. Okay, yeah,
other
so wait and
manufacturing
see.
As well.
More to develop there. Right. Well, we did just learn this week the Supreme Court did not make a ruling on the anticipated case regarding the legality of President Trump's tariffs. This is a big case a lot of people have been watching. Can you remind us what is at stake there and when we could expect a decision from them? So
about half of the increase in tariffs is on trial at the Supreme Court for the moment. And so there's a big legal question about whether the executive or legislative branch sets tariff policy. And so the president, a lot of the tariffs imposed are under the Emergency Economic Powers Act. And that is what's being heard at the Supreme Court. Now, the administration has already broadcast that if that is ruled down or ruled against the administration, they will try to re-engineer the tariffs through other channels so that the effective tariff rate doesn't change, just the means of getting to that effective tariff rate would change. So it will be disruptive for financial markets and manufacturers and whatnot as they have to once again adapt to a new slate of tariffs. But it will be more status quo compared to where we were last April when this was truly disruptive to financial markets.
Interesting.
The other side of this coin, if they don't re-engineer those tariff rates, is a potential financial disruption. I don't want to say shock. That's a troubling word.
Yeah.
It could verge on shock. But tariffs are paying for a big share of the tax cuts which were passed last July. If tariffs are overruled by the Supreme Court, suddenly there is a much bigger price tag on those tax cuts, which means the U.S. Treasury has to issue more debt. That could put pressure on interest rates, and that impacts everything from your credit card to your mortgage, your auto loan, the cost of businesses borrowing, and that could be problematic for the economy. So it's not just a quick read of, the tariffs are gone and that's good news for the economy. Yeah. There could be a kind of unintended second consequence that we need to pay careful attention to.
Because the Trump administration is sort of banking on this structure that has now been established.
Absolutely. Banking is the operative word there, where tariffs are a tax.
Yes.
not necessarily paid by consumers, sometimes paid for by consumers, but it is raising significant revenue, which is helping to pay for those tax cuts from last summer.
Interesting. Something else this week. President Trump, of course, a supporter of using tariffs, he has said many times. This week he also said...
His favorite word in the dictionary, he said.
Tariffs, yes, exactly. Big fan. This week he said that any country doing business with Iran could face a 25% tariff. So that's a lot of countries, including China. What impact could that have on Oregonians and consumer pricing here?
Well, in terms of the direct impact with Iran, Iran has faced such heavy sanctions for so many years that there are very few U.S. entities that are doing business with Iran. So that direct channel, I don't think will be very disruptive to the U.S. as a whole or to Oregonians in particular. The second order impact, which is then those businesses like China, for instance, which are doing business with Iran, that could be more disruptive to the supply chain. But it seems to be a very fast-moving cadence of developments in Iran, and I don't know if this will endure long enough to actually see what an extra 25% on Chinese products or otherwise would be. And it looks like foreign trading partners are taking this seriously and potentially pulling back.
Okay. Well, let's look ahead now as we begin 2026. How does the state stand right now? You talked about it a little bit at the start of the show and moving ahead into the year.
Sure. Well, I think a big focus is going to be the labor market. And we had a poor start to 2025. Towards the middle of the year, we started to see some signs of stabilization, some flickers in the labor market with a positive month here or there of job creation. The unemployment rate continues to rise in Oregon. It's 5.2%. That is lower than the average over the last 25 years. So it's easy to say, well, we've gone up so much since the pandemic, but it was truly an exceptional period post-pandemic where the economy was red hot, the labor market was extraordinarily tight, and so this is some rebalancing, some normalization. Now, it's not equal across the economy, so certain sectors are doing better, services versus manufacturing, as we already discussed, for example, but we're starting to see some improvement there. In the national labor market trends, and Oregon can't be divorced from what's happening nationally.
Absolutely.
So if the national economy is showing signs of reacceleration, it's going to pull Oregon along with it. And so nationally, we've seen the unemployment rate actually edge lower over the last couple of months. So this is, again, just a couple of data points, so it's too early to say a trend, but it could be the beginning of a new trend where the labor market is kind of stabilizing as the economy is reaccelerating. And so this, I think, is a very critical narrative for 2026. For most of the pandemic period, post-pandemic period, each year has been slower than the year before it because policymakers were putting on the brakes. Whether it was fiscal policy or the Federal Reserve with interest rate policy, we were trying to slow the economy down to rein in inflation. This has changed now. The Fed has cut interest rates considerably, almost 2 percentage points, and tax policy now is more supportive of the economy. So there are real reasons to think that 2026 is the year we break the trend, and that deceleration kind of levels out and possibly starts to reaccelerate with tax cuts supporting the economy, interest rates supporting the economy, and more stability on the tariff front. So you may not like tariffs as a business, but at least if you kind of understand the rules of the game and you're not seeing these big fluctuations in tariff rates, at least you understand the rules of the game and you can plan accordingly.
So a lot of the uncertainty is part of the problem.
Uncertainty is a huge tax on private sector activity.
Well,
so it looks like in 26 we're starting to see maybe this, if we think of a hockey stick or a check mark, we're starting to see that upturn. Now it's not off to the races, no concerns. There are very real problems in the economy in certain parts of the labor market. It's a K-shaped economy, meaning that some folks are doing quite well and some folks are not keeping up with inflation and facing a weak labor market. So it's not to have a rosy picture across the board here, but at least there are some encouraging green shoots of a pickup in activity for 26.
I want to talk more about the household reality of Oregonians and the cost of living for 2025. You touched on it a little bit. Those who are in middle income to lower income families, how are they impacted and can they see maybe a real difference coming into 2026?
Well, we've had an affordability crisis
Yep.
post-pandemic with surging housing costs, whether it was ownership or renting. Inflation across the board has been elevated. We had some inflation data earlier this week, which shows that we are still not back to the objective of 2% inflation. We're running hot relative to that, closer to, let's say, 3% on the inflation side. And so households are struggling with these affordability issues. Now, energy prices have come down, so that should provide some dividend to households. But food inflation is still, high, and that's not something you can substitute out of, right? If the cost of a pair of sneakers goes up, well, I'll use my sneakers for a longer period of time or whatnot. Food is something you really can't substitute much for, and so there is still a persistent inflation problem there. And this slowdown in the economy that I've been describing has meant a slowdown in the labor market. It has meant a slowdown in wage growth, for much of the labor market. And so, what we saw post-pandemic, even though we had high inflation, it looked like workers' wages were actually outpacing inflation for a lot of that period. Not all workers, but on average. And the reality in more recent years with this kind of moderation in the economy, which was the goal of policymakers to slow things down, right, was that we saw that gap narrow. And so some households are still keeping ahead of inflation, but an increasing share of households are falling below and not keeping up with the rate of inflation. And so affordability is a dominant theme for 26, and it will continue to be problematic.
Okay, so even if we might be seeing that beginning of the curve of the hockey stick, it could still be a while for our families, our middle class, lower income families, to really feel it.
Absolutely.
Okay.
Absolutely.
We are out of time today. Carl, thank you so much for being here.
My pleasure,
I
Stephanie.
learned a lot from you. Appreciate it.